Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, July 30th, 2024. As always, we'll start with the executive summary from today's lit-off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, what did the Q3 QRA signal about the outlook for U.S. liquidity? Can Europe's growth cycle upturn persist throughout the pending slowdown in the U.S. economy? What are the corrections in commodity signaling, and how long will the labor hoarding phenomenon persist in the U.S. economy? Our answers are: part one of the Q3 QRA was supportive of the medium-term outlook for U.S. liquidity and, by extension, global liquidity. Absent a significant increase in the ratio of coupon and bond issuance in part two tomorrow morning, we are likely to terminate our Janet 1 softer inflation theme, the anchor theme of our left tail risk section in recent monthly macro scatter reports. That's bullish. A bifurcation has emerged between upwardly sloping lagging hard data and downwardly sloping leading soft data in the Eurozone economy. We believe the corrections across commodity markets are signaling to investors to revise down their medium-term expectations for European and global growth. The June JOLTS report will provide our latest clue as to when the labor hoarding phenomenon will end in the U.S. economy. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one's regarding shelter costs increasing. It reads, housing inflation is creeping up again. Given the lag, it looks like we are still have a few more months down, but is there a risk to shelter disinflation thesis? Absolutely. And this is something that we've been consistent with since going back to January of 2022 when we authored our sticky inflation theme. The key takeaway from that theme is that unless we go into a recession, we are very unlikely to have inflation return durably to trend and durably to the Fed's 2% stated inflation target. And so in our view, if you look at things like the leading edge of home price appreciation, as well as core producer prices, we're already bottomed at a level that's wildly inconsistent with 2% inflation and are accelerating already from those levels. So some of the more lagging indications of inflation, like housing PCE, shelter CPI, housing PCE, those things are continuing to decelerate and are likely to continue decelerating over the medium term, as per what the leading indicators have already signaled, several quarters ago. However, it's very likely that we return to levels that are consistent with 2% inflation. And in our opinion, that's something that asset markets may have to contend with throughout 2025. But again, I don't think we're there yet in terms of this being a real significant market risk. So we'll wrap it up there. Darius Dell presenting our macro minute for Tuesday, July 30th, 2024. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.